Welcome to Stocks in Translation. I'm your host, Jared Blikre, joined as always by the voice of the people, Sydnee Freed. And before we get started, we want to make sure that you like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, YouTube, wherever you get the podcast. And today we are welcoming Michaella Gallina. And thank you for dropping by because you are the Chief Financial Officer of Wave, and you also have a special position in investor relations at H&R Block, the tax preparation firm. We're going to be exploring all of that. Let me tell you guys what we're going to be talking about today. You're going to love this one because our phrase of the day is value stocks. And I know that's H&R Block. You got an incredible story there. Value stocks are back in vogue. And the big question is, for how long? This episode happens to be brought to you by the number 11 trillion. That is the number of dollars, the peak total monetary and fiscal stimulus of the U.S. in response to COVID, what the debt and QE hangover mean for taxpayers. And Michaella, let's get into, I like to ask each of our guests what you're thinking about the market. Kind of crazy, we're at record highs, Fed's lowering rates, good news all around, but there's been some turbulence. What do you think's going on?
Absolutely. When I look at a PE ratio today of 24 times, it makes me a little nervous, to be honest with you.
A little high.
And that's one of the reasons I feel really confident about picking the right value stocks right now. I think there's been a lot of hoopla around some unicorns that we're seeing with tremendous growth, but the fact of the matter is that's not the average market, and if you want to beat the market, you need to play with what's in the game. And so that's one of the reasons why I'm still bullish on H&R Block, even though we've increased 190% over the last 3 or so years. We're a steady compounder. When there's a risk trade happening, we cash flow about the same amount of money every single year in a good year or bad year. We return essentially all of it to shareholders, and there's not a lot of volatility in the tax industry. In fact, it's highly correlated to employment. Over the last 60 years.
And we've seen a strong employment market.
That's right. And over the last 60 years, it's grown about at a 1% CAGR. So it's very steady in compounding.
Compounded annual growth rate. There's going to be a little thing that pops up on your screen there for that. But now we want to get into the very important definition. We're going to define value stocks. And a lot of people know this, but it's good to review. A value stock is a share of a company that is considered undervalued compared to its financial performance, such as earnings, dividends, sales. So we're comparing it to its potential or its peers. And you've worked on both sides of this, and I think you can tell a really interesting story here. And we're going to get into kind of like the compare and contrast later, but tell me how you approach value stocks. How do you find them?
Great question. Honestly, I can start with a pretty basic screener.
Sure.
I look at a company's price to earnings ratio, over the last decade.
Can you define price to earnings ratio?
Yes. Stock price of the company divided by forward earnings the next year out.
Nice.
And so if you map that over, call it a decade or maybe 5 or 6 years, depends on the company and what they're going through in their current life cycle. But I like to look at that chart, and then you can kind of create bands based on its trading range, right? And you can put a median trading multiple on that stock, and anything beneath that I'm going to be keeping a very close eye on. And you can watch them trade, and when they're undervalued and they're these compounders that you talked about, if you believe in that story over time, it's going to get back to where it should be and higher.
Go ahead.
I was going to say, I just feel like recently people have been saying it's been a bad time for value stocks, and now all of a sudden maybe we're seeing this resurgence. Do you think that
it's been
value?
A bad time for decades.
It's been, I guess is like. Do you think value stocks are having a comeback? Is it going to stay that way, or is this just like a little blip that we're seeing right now?
Yeah, how long?
It all comes down to stock selection, right? And it's so hard in today's day and age to be a stock picker. It's harder than it ever has been. So is there the value trap where you get stuck in a company that's undervalued, that's never going to do anything to change, and it's going to stay undervalued for a long time?
People thought that about GameStop, and then we had an explosion.
That's right.
What did you think when you were going through that? I mean, I think you were at H&R Block. Correct me if I'm wrong, but what did it look like from your perspective when we saw that amazing thing in 2021?
Honestly, that was shocking to me. And
everybody says that, yeah.
Everybody says that, right? But when I looked at it from my perspective in investor relations at H&R Block, I was actually worried that was going to happen to us, in both a good way and a bad way, because
people know your brand very well.
We have some of the greatest brand recognition in the world.
Could I ask you, what would you have done?
It's a great question. Sell all my shares. Just kidding.
No.
I would not do that. It's interesting because in our roles, we speak primarily to the institutional investor. Mm-hmm. So it was amazing to see a retail investor have that much force in the marketplace. Yes. And still today, I mean, we're even seeing big jumps of it.
How do you go about picking a value stock? Like, I know there's a lot of math involved, but if I just want to basically be like, all right, I'm putting some money in my brokerage account and I'm going to pick a couple value stocks, where do I go? What do I Google?
So maybe even before you get to that
Yeah.
screener, you were just talking about real basic stuff.
Strong, consistent earnings and cash flow over time that's predictable and stable. That's
And
the big thing.
And is it a company like a tax company? It also has to be a company that you feel like is even, has not a lot of volatility. Is that right?
I would say, generally speaking, yes, that's true.
What about growth stocks? On
Yeah,
the
the
other
opposite side.
Yeah.
Right. I mean, growth stocks have been in vogue for
You
a
like
very, very
NVIDIA?
long time. And this is probably just in my nature, I like things that I can understand, and I like things that I can understand from a valuation perspective.
You don't understand 7 nanometer like fabrication in the chip space?
Exactly.
GPUs.
I don't pretend to know anything that I don't, and the valuation, even the S&P's valuation right now, seems very rich. I mean, if you put it on one of these charts that
Sure.
we're talking about, it's rich, relatively speaking.
What about a company like Apple, though? Even Warren Buffett eventually got into Apple. Maybe it was one of his money managers. Maybe it wasn't the Oracle himself. But, Buffett has been wading into some of these growth names now.
Yep, absolutely. Well, it's a market leader. So when we talk about value stocks too, I think having a brand like we've talked about and being a consistent performer and having consistent cash flows, that kind of tends to
And
go
you can
hand in
understand
hand.
their maybe Apple's business model a little bit better than NVIDIA, just in
Right.
terms of the product. So
Right.
I kind of get that.
Do you think you should have a certain amount in your portfolio of growth versus value?
Oh, definitely. You have to have diversification unless you're a value fund and that's what you're, going to be measured on. But firmly believe in diversification. I just think people have focused even more so on growth and they've forgotten the value stocks, which in some cases have significantly outperformed the growth stocks, especially when you've got risk in.
You have kind of a bird's eye view into the American consumer. People are filing their taxes, so you kind of know on an intimate level, and then you aggregate that. I imagine you have some insights into the consumer. What are you seeing at H&R Block?
Definitely. In fact, we hear year after year that the American consumer tells their tax pro more than they even tell their spouse about their financial situation.
I can see that.
We know
I can
a
see
lot
that.
about the consumer. What was so interesting to us during the pandemic when stimulus payments were getting made was that the consumer was flush with cash. So they didn't come in early to get loan products and advance products that they would typically pay back with their tax refund because they actually were getting so much money in payments every month they didn't need that, which was amazing. This past tax season, we saw the consumer more in need of cash. So they came in earlier to get a loan on the refund that they might use to pay that loan back with. We have a product called Emerald Advance, and you and I don't live like this, so I think most of America, or most of us, don't understand what most of America is like. There's a huge consumer that comes in and gets a loan in November and December to pay for Christmas presents, and then uses their tax refund or other sources to pay that loan back. And so this year, we saw a reversal in this trend of consumers being flush with cash, and they came in earlier and in need of more cash. About 75% of Americans get a tax refund. That refund is on average, call it $2,900. And that is the biggest financial payment that most Americans get. That's more than their paycheck. So the refund is a big moment.
Do you have any insights as to what's going on potentially into the end of this year and next? Or what, if you don't have that just yet because it's too soon, what are you going to be on the lookout for?
The tax industry, as we talked about, is very stable, but there are always nuances year to year. So we're paying attention to 1099Ks, for example.
Which are?
If you are transacting money over platforms like Chase, Zelle, Venmo, for example, the IRS is basically trying to capture the small business portion of that, what's truly a business. So normally that 1099K is if you and I ran a small business and you were, say you were an Etsy company out of your house, right? They're trying to capture that little bit amount of spend to be taxed. That threshold for the 1099K used to be called around $22,000. The recent regulations have actually taken that 1099K down to less than $1,000.
Yeah,
Now,
so the exemptions are kind of gone, and that's a lot. That adds to reporting requirements. What about enforcement? Is this being checked aggressively yet, or how's that
well,
work?
it's been delayed 2 years in a row now, in part for these payment processing companies to be able to even issue Form 1099Ks. But I think also because the threshold is likely a little too low or is going to cause a lot of confusion. But confusion in tax law is good for H&R Block because that drives clients to seek help. And who do you go for when you need help with your taxes?
Is your tax person basically your therapist? I feel like that's what I'm hearing. I have a question. If you're a gig worker, because there's so many more gig workers these days than ever before, the taxes seem like they might be really complicated. Is that just me?
With
Like
that 1099 form you were just
maybe,
talking
yeah.
about?
So
what do you need to know
complicated.
if you're a gig worker?
The U.S. tax code is incredibly complex. In fact, if you include all the details about every regulation and guideline, it's 75,000 pages long.
I'm not reading that.
And it has only become increasingly more complex over the years. So we'll be watching the election, and it's not really a matter of which party wins, but anytime in recent history when one party wins, they come to the table, they want to make a tax law change. The other party says, okay, we want these changes. And as a result, it continues to get more complex. So that's part of it
I did want to ask you about the election outcome. So that's kind of your angle there, is what is it going to look like through the tax lens? Anything else you're looking for in the election?
You know, interestingly, from a tax perspective, there's really not enough time to get a whole lot changed. And that's always on the table. Someone could come in and go, you know what, we should increase the child tax credit, and that's something I want to do right away. But for the most part, after an election year, it takes a year cycle for those big changes to take place. And we actually think the tax industry is going to be very stable. We're expecting that 1% filer growth next year.
All right. Pause right there. We need to take a short break, but coming up, we're going to be talking stimmies, so that's stimulus of the fiscal and monetary kind. Plus, we pit the C-suite versus Wall Street buy side in today's, or sell side in today's Who Wore It Better. Stay tuned. And we are back. This episode brought to you by the number 11 trillion, and that is the dollar amount of pandemic response in the U.S. by the government. On the fiscal side, that's taxpayer and borrowed money that was spent by the government directly. So fiscally, we have nearly $5 trillion. There was the CARES Act, Consolidated Appropriations Act, American Rescue Plan Act, $5 trillion there. Then on the monetary side, we have the Federal Reserve. They dug deep and made a few new plays, in total worth about $6 trillion. Now, some of that, a lot of that was just emergency lending, which has rolled off, but the Federal Reserve has its balance sheet where they bought a bunch of mortgage bonds and treasuries, and they still have $7 trillion. A lot of that is a hangover from the global financial crisis. So you add it all up and it's 11 trillion. Does that bother you? Does that worry
That's
you?
why I'm here to talk about value stocks
All right.
today.
Here we go.
Yes, it does in fact bother me. I mean, you put a lot of data points together. Let's go back to valuation.
Sure.
The market's trading at 24 times. We just put in essentially 11 trillion. We haven't gotten through the unwinding of what we did to buy bonds you just talked about. That makes me pretty nervous. When I look at the consumer, they have the same or more levels of credit card debt than they had before, and personal debt. Unemployment has remained strong, and to me, if unemployment can remain strong, then I feel more comfortable with where we're going, especially with the Fed reducing rates. But overall, as a value investor, to me, the market in general feels very rich with all of this in context.
After the pandemic, we did see some of the highest inflation since the 80s. Do you think it was more like the monetary or the fiscal stimulus there?
That's a great question. I don't know if I'm the expert to parse that, but all I know is that when I hear inflation data come out and it's like, oh, 2.5%. Yeah, maybe year over year, but if you look at inflation since the beginning of the pandemic, since let's call it February of
2020.
Yeah, exactly, when the pandemic-induced recession kind of started, prices, the CPI and prices are up, over 20%. And
Right.
I think every consumer would agree with you. Their life has gotten so much significantly more expensive than their earnings growth has been able to keep up with, whether it's property taxes, whether it's groceries, whether it's rent. Across the board, I think the consumer is feeling very crunched right now.
The counter to that, and you were just talking about, well, let me go back because we were talking about, is it fiscal or monetary? I think a consensus has kind of emerged that it was the fiscal had the most juice because the global financial crisis was mostly monetary, and then we got stuck with almost zero interest rate policy for
Right.
years and years and years. So what do we do here? Let's say that we have a situation. What do you recommend going forward?
Yeah, great question. I do think lowering of rates slowly is the right thing to do. I don't think going back to free money, what we had a couple of years ago is the right thing to do, but to slowly decrease them probably makes sense from here. We need to start slowly unwinding, and we kind of have been doing that, but we have a long way to go from there.
In terms of that, giving back some of those bonds, lowering the balance
Correct,
sheet. Yeah.
correct. But you can't do all of those things all at once after the magnitude of all of the things we just did, in my opinion.
I think we've tried, and with limited to no success in various ways before. The unwinding of QE was supposed to start in 2010, and that got postponed by years, like half a decade. So yeah, it's been tough to wind all this down. But the Treasury has kind of pursued this strategy where they're issuing lots of Treasury bills at very low rates, as opposed to like the 10-year. So
Right.
if they were to issue all the debt they were issuing in 10-year, they would be paying a lot more interest rates.
Right.
But so there's an argument that they're just issuing too much short-term debt that's going to have to be rolled over anyway. But now the Fed is kind of lowering interest rates, so everything's going to be all right. Do you see this working out? Possibly?
Possibly, but I think it's going to be very tricky, very difficult. Nothing ever goes as smooth as you think it's going to. But I think one of the other problems is that the consumer, and I think frankly businesses in today's age, with what we've seen since the global financial crisis in 2008, is that the government is going to step in some form. So if things start to go haywire, right? I think consensus is they're going to step in and do something else to try to smooth it out. And I think that's a really dangerous road to go down, because at some point they're not going to be able to correct things at the magnitude that they've been putting, stimulus into the marketplace. They're not going to be able to move as fast to correct that, whether they decide to do something or not. And I think their hand is being forced in today's economy to step in and do something. But
so then the people who are used to all this, reactivity by the Federal Reserve and the authorities just kind of saving everything at just in time, that might not be able to happen, and so people would be under false assumptions. Is that what you're saying?
That's how I feel, yes.
All right.
But what happens if the government doesn't step in?
Yeah, so what happens if they, so they're not able to step in, there's a crisis, and the amount of fiscal and monetary stimulus that the public believes they need just isn't there.
Yeah.
So what happens there? I mean, that sounds like civil unrest.
But
like chaos.
Potentially in today's day and age, I mean, if you have a shortage of food for 2 days, it could be like pitchforks in the streets. But if you look back over time, this is where I always gain confidence. If you look back over time and the cycles that the economy goes through, it naturally does that and needs to do that at times. There's going to be pain, there's going to be prosperity. Usually those cycles of pain breed more cycles of prosperity, and you keep going. I think we've gotten a little too dependent on trying to put our hand in the market to control things, and I do think at some point that's going to be difficult to contain.
We got to get to today's Who Wore It Better. This is a rip-roaring one. Let me just find my place in the rundown. We have two ideas juxtaposed, and Michaella, we're going to talk about your career moves here.
Okay.
All right, so on the one hand, we have the sell side. That's where you started out, the faction of Wall Street that's geared toward creating, promoting, and selling securities like stocks and bonds. And on the other, we have corporate finance, where you are now, those who actually make the decisions and steer strategy. So you've worn both hats, and you have a really interesting story about Howard Schultz, the former chair and CEO of Starbucks. He kind of helped you switch roles, so tell us about it.
That's right. I started as a sell-side investment banker. Then I actually went to the buy side doing growth investing. And it was there where we were a large shareholder of Starbucks. And so about every quarter, I'd go up and meet with Howard Schultz. And, as every buy-side analyst is trying to do, I'm up there trying to get my edge, right? So you come in totally prepared with a line of questions, and you think you're going to outsmart Howard Schultz. And it was before an earnings, and I had a feeling that the comp they were lapping was going to be easy. I asked this line of questioning, felt pretty comfortable with that thesis, got home, we bought more of the stock. Long story short, they report earnings. That thesis ended up being true.
The comp was bad.
The comp was easy for them to lap, so they actually beat by significantly more than what was expected.
And you had bought more.
And we had bought more. So we're like high-fiving. Nice. I'm probably 25 at the time, and I'm like, oh my gosh, I just made a big trade on Wall Street.
Do you feel like the Wolf of Wall Street at that moment?
Like you go from being bottom of the barrel to like overnight, like, oh my gosh, know how to trade stocks. And then, as we're having this moment around the office where everyone is high-fiving and we just made a ton of money, I just thought about this interaction I'd had with Howard Schultz, and I was like, I just asked him questions. Howard Schultz is the guy who's driving tremendous value out of Starbucks. I want to be him. I don't want to be the person trading around stocks. I want to go drive it myself, and that's what led me to go to the other side of the table.
What's it like driving the bus?
Way harder than anyone thinks. And I say this all the time.
Everyone says that, by the way.
Okay, good. I say this all the time, but I think if most investors, if they've never been on the corporate side and they got a peek behind the curtain, they would find most companies completely uninvestable. It's just a totally different language, totally different viewpoint than what each side is looking at. And there's a real language and barrier gap between the two of them. So it's a very interesting perspective to try to match those two up in my role now.
When you were talking to Howard Schultz, did you have like an elevator pitch? I feel like when you meet someone like famous or like big, they're like, yeah, in 30 seconds, like tell them your story. Like, did you have something like that?
You know, he knew us very well because we'd been big time shareholders for a really long time. But again, I was so young. I was just going in there and I'm like, I have to sound smart. I have to be so prepared. So it's like days and weeks, and on the plane ride up to headquarters, you know, you're like doing all of your research and preparing everything and preparing for every angle of every question to try to get to where you're, you know, trying to dig into and find the truth in. So
I love that. Before we get personal, I want to do another stock question. Earlier in the show, you said it's harder than ever to be a stock picker. Why is that the case?
Oh gosh, so many different reasons. And you know, a lot of these I don't even have to tell you, but high frequency trading makes it more difficult than it ever has before.
We just had a guest on, Tom Sosnos, the other day, and he, by the way, he founded Tasty Live and Thinkorswim back in the day. He's all about high frequency trading. It's just a tool that gives investors a better edge. But you're saying it comes with a cost.
I think it does. And I think this is what I say all the time to my friends who are like, oh, what stock should I be picking? I'm like, you shouldn't be picking any stocks. You need to leave that to the professionals, because there truly is, in my opinion, a difference of information in what I get as an analyst being able to go have a direct conversation with Howard Schultz, for example, to you who's reading a press release when it hits their website, when high-frequency traders saw that hit Bloomberg and had a trade ready to go instantly and could handle all of that.
But if you're a long-term investor, does it really matter? You know, does it matter the few pennies that you're not going to get in on?
Here's my other bone to pick with that view. If you are truly a long-term investor, I think the market would be a little bit more rational. I think with high-frequency trading and, you know, today's mindset of I want to make a quick buck, I think we're way too focused on short-term gains. And the reason I think that is because companies like H&R Block, we're valued over creating value over the long term, but we are measured on a quarterly basis. And that creates a very tricky situation to really believe in long-term value if you're going to be measured on the short term.
Do you think we have too much liquidity?
That's a good question. I think there's a ton of liquidity on the sidelines waiting to go into the market. I do think that's a little bit of a padding saving grace if things go haywire. I think a lot of people are waiting to step in without much cash.
So what's your one piece of advice for like an early investor and maybe someone who doesn't know that much about the stock market?
Pick low fee mutual funds. Don't try to be a
Not
hero.
ETFs?
ETFs,
Okay.
yeah, low for sure. Mutual funds or ETFs,
Okay.
I would say low fee, like a Vanguard, for example. Earlier in your career, the more aggressive you can be, so pick further out retirement funds, for example, and stay diversified. Now, as a young investor, you can take a lot more risk. So you're able to have, like we talked about earlier, greater diversification in riskier, trickier assets. But I would say the biggest piece of advice is start investing early, any amount of money. The compounding, the compounding interest is most important at that age.
We have 30 seconds left. You are a national champion in equestrian show jumping. I had to look to
Any
say
parallels
show
here?
jumping. Yeah. How does working, with the stock market relate to equestrian horse jumping?
I say this all the time. Riding a 1,200-pound animal against the clock over 15 to 17 jumps is way harder than anything I've ever done in my day job. They've got a mind of their own, obviously, but it makes you better because it makes you basically what I say, practice my guts. Every time I go in the ring and the buzzer goes off, I'm like, I don't know if I can do this. But there's no one coming to save you, and you got to go do that. And when you get reps of grit, essentially, then anything that comes up at work, there's no crisis that makes me panic. It's like, okay, this is a situation. Now what do we do about it?
Because you've seen it worse with horses. I love it.
Way worse.
Is the Olympics your next goal?
I am not on track to be an Olympian. I wish I would have starting at the age of 5, but not now. But
I
love
believe
watching
in
it.
you. I believe in
I
you.
believe too, but we do have to leave things there. I want to make sure that everybody checks out our other episodes of Stocks in Translation on the Yahoo Finance site and the mobile app, plus on all the podcast providers like YouTube and Apple. That's all for now. Keep it tuned to Yahoo Finance.